All right, so we are ready to wrap it up, this reading on free cash flows. Let's look at some other minor aspects of this reading. There are two approaches to forecasting FCFF. Remember, the whole purpose of this exercise is to do valuation. And we want to be able to forecast cash flows so that we can discount it and bring it to today to get to the value. Now, no matter what method you choose, you want to put an end to your cash flow stream so that you can practically use it to do the valuation, practically plug it into your calculator and compute the present value. One thing to do, one approach to forecasting cash flow is applying a constant growth rate. So if I apply a constant growth rate, it becomes nothing other than Gordon growth model, right? So we are applying a constant growth rate to future cash flows, and if that is a valid assumption, if we can, if we think that it makes sense to apply a constant growth for this specific company, indeed it is perfectly valid. Alternatively, one way to do, other way to do it is to look at the components of your free cash flows. So you have the 5-part decomposition, and each component may be growing at slightly different rates, in which case you apply their individual growth rate for individual components. Very, very unlikely, very time consuming, and again, when you are looking at a perpetuity, when you are looking at applying a growth rate forever, it would not be practical to have a significantly different growth rate for this individual component. So yeah, in stage 1, for the first 5 years, for example, you may have differences in growth rate for individual components, but at some point in time, the growth rate should map out, should be equal for the components. Now, an important formula in this reading is forecasting FCFE. The key here is not FCFF, but FCFE. And that is under an assumption that the capital structure is constant fixed. So if you are given a target capital structure, or you're given that the target capital structure is going to be constant at 40% debt, 60% equity, when given precise instruction about constant capital structure, then only you want to use this formula. In fact, those are the key words you should be watching out for. So when you are given a constant capital structure or target capital structure and given specific debt ratio. Now this debt ratio is debt to asset ratio. Okay, same thing. And debt ratio is linked to debt to equity ratio. So if you are given debt to equity and you have to derive, you have to calculate your debt ratio, then your formula is debt to equity divided by 1 plus debt to equity, right? So be able to calculate your debt ratio given debt to equity and then apply it in this formula. Now what this formula is really doing is recognizing if your target capital structure is constant, then your net borrowing is going to be a precise function of investment in fixed capital and working capital. So your net borrowing is equal to debt ratio times investment in fixed capital and investment in working capital. Now we are making one minor adjustment. We are recognizing that, remember, depreciation that we have been using as part of our NCC in our formula, that depreciation we are adding back to net income because we consider it as non-cash expense. Now we are going to assume that that non-cash expense is simply a provision for replacement of fixed asset. In other words, that becomes a source of our fixed capital needs. That becomes a source of cash to fund our capital expenditures. So I'm going to only need the net amount remaining. So fixed capital investment is what I need for replacement of assets or expansion of assets, and some portion of that need is already met by our provision, which is depreciation. So the net amount that I need to fund is fixed capital investment minus that depreciation. So that is your net borrowing. So net borrowing is debt ratio, the proportion that is funded by debt, multiplied by your cash flow needs on account of net investment in fixed assets and investment in working capital. So that will be your net borrowing. If I can assume that and I substitute in my FCFE formula, So my FCFE 5-part formula, if I plug that net borrowing in this formula, that is when I get my forecasting FCFE formula under a strict assumption that my debt ratio is constant, my capital structure is constant. All right, so this is a key formula to memorize, to keep in mind. Okay. Now, let's talk about comparison between FCFE and dividend discount model. So recognition of value between FCFE and dividend discount. The idea is the valuation models are same, but the numerator is different. So remember, numerator in DDM is dividends, numerator in FCFE is free cash flows. Now, conceptually, you may imagine that FCFE is the cash that is available to be paid out in dividends versus dividends is actually paid. So you may be inclined to think that the numerator is higher always vis-a-vis the dividends. Well, not so, because at some point in time, when the company becomes a mature company, when it is growing at a constant rate, your FCFE and DDM should match, which should be equal. The company cannot into perpetuity hoard cash, right? So that is where the mapping comes into play. That is when you recognize that indeed they should be very similar. The only distinction between the two is recognizing that FCFE based valuation includes a control premium. Now let's look at the effect of financing decisions on free cash flows. So, and this is an important component of learning outcome for this reading. So what if something changes? How does it affect your free cash flows? Now remember, when you're looking at FCFF, it is the household which has two members, debt providers and equity providers. And when you're looking at FCFE, you're looking at only the perspective of equity investors. Any cash flows from a member of a household cannot essentially count as a cash inflow. So if you are changing hands between husband and wife, well, that is not really adding any value or increasing the wealth of your household. So losing a bet to your spouse, the money stays in the house. The household wealth is unchanged. So keep that logic in mind. Any payment of dividend is a use of cash flows. It does not change my cash flows. It does not increase my cash flows. So you see the first one, payment of dividend, is a use, not a source of cash flows. Similarly, stock buyback is also a use, not a source. Stock issuance, well, you cannot issue stock and say, hey, now all of a sudden you took money from your equity investors and say that money is available to be paid out to the shareholders. You're not going to create value by taking money from the members of your household. So it doesn't change. So these are intra-firm or specifically here it is only equity investors. This is within the house cash flows. It is not changing the household's wealth. Change in leverage, meaning you are now either borrowing more or borrowing less as far as debt is concerned. For FCFF, it is same as issuing additional debt or buying back your, in case of FCFF, it is same as issuing additional shares or buying back your share. So that is why you say there is no impact on account of change in leverage. But when it comes to FCFE, if you're borrowing more, remember you're adding it to FCFE as net borrowing. So if you increase your borrowing, well, your FCFE goes up. But the key here to keep in mind, the short-term and long-term impact offset, meaning the year in which you increase your borrowing, yeah, there is net borrowing being added. However, in subsequent years, in future years, what happens? Your interest expense will be higher. Remember, interest expense is higher, that means net income will be lower. When you calculate FCFE, you are not adding back after-tax interest. So your higher interest lowers your net income, and so future free cash flows will be lower. And that is what we mean by difference in impact in the short term, in the current year, as opposed to future years. Now let's look at the using proxies in lieu of, instead of calculating FCFE. So can I just use a shortcut? I don't want to go through the whole exercise of calculating free cash flows. Well, remember, free cash flows are curriculum recommended valuation metric, and therefore they are the gold standard. So anything else is a poor proxy. So keep that in mind. Why is net income poor proxy of free cash flow? Well, net income is an accounting term. It's an accounting earning. It has all the manipulation that accountants can do. It is not a cash flow metric. So net income is a poor proxy for FCFE. Why does it differ? Remember, there are 5 components in FCFE. Net income is just one. What other components are there? Depreciation. What other component? Investment in fixed capital, investment in working capital, as well as net borrowing. All of these other 4 components are not captured if I use net income as a proxy. So that is the concern. That is why net income is a poor proxy. What about EBITDA? If I want to use EBITDA, and oftentimes EBITDA is used as a proxy for cash flows, specifically proxy for pre-levered cash flow because it is before interest, so proxy for FCFF. So pre-levered cash flow, again, you're looking at firm cash flows. So why is EBITDA a poor proxy? Well, first, taxes are real. It is before taxes. It ignores the impact of the tax shield. It is before depreciation is deducted, but it is not the same. Remember, if I start out with EBITDA and then multiply it by 1 minus tax rate, I always have that additional tax shield being added. If I go back to the formula, you'll see it, that the depreciation tax shield is added in that formula whenever I have EBITDA as a starting point. Well, if I use EBITDA, it ignores that tax shield. That is not included in your analysis. And then finally, EBITDA, remember, is not subtracting investment in working capital as well as fixed capital, while FCFF does. Now, if I want to use a single stage model, meaning if I can assume realistically that the growth rate is constant going forward, then what is the formula? Well, this is the easy one. Remember, it is FCFF1, next period's expected free cash flow to firm, divided by R minus G. If we are looking at firm cash flow, that R, the required rate of return, becomes what? The firm's cost of capital, which is the weighted average cost of capital. So we use WACC in the denominator. Make sure your numerator and denominator matches. This is again only suitable for stable firms in mature industries. Why? That is only time when we can assume realistically that the growth rate is constant. Now, what about FCFE? If that is what you're starting out with, if you want to go straight to the valuation of equities, again, single stage Gordon growth model, now you need to use the cost of equity or the discount rate applicable for equity instead of for the firm. That is the distinction. Otherwise, basic Gordon growth model, once again, only applicable when you can imagine growth rate is constant. So if I want to use multi-stage model, now again, this reading is not too concerned about complex growth patterns, about complex model. We are more concerned as far as testable implications go about how to calculate those free cash flows, FCFE or FCFF, as well as how that free cash flow change and when I make a tweak to one element. What if interest goes up? How does it affect my FCFE or FCFF? Those kind of questions. Nonetheless, the learning outcomes ask us to know what kind of variation would be appropriate. Well, we need to adapt the model to fit to the firm characteristics. So if the firm characteristics calls for a 2-stage model, use a 2-stage model. If it is a 3-stage model appropriate, well, use a 3-stage model. If I want to use a 2-stage model, what should I use as terminal value? Can I use GGM or price to earnings multiple? Now the curriculum continues in this reading to say you can use Gordon growth model, which we already saw, or the price multiple. Remember, terminal value computation using a price multiple was also covered when we talk about dividend discount model. Here too, you can calculate your terminal value using a price multiple. I find it a little disconcerting personally because when I use a PE ratio, a price multiple, this is really, the price is a minority perspective. I'm kind of mismatching terminal value based on minority perspective with free cash flows, which are control perspective, but that is what the curriculum says. So I'm kind of imagining I will imagine that the P in this PE multiple is a takeover price or a control perspective price. That is the only way it would make sense. I'm kind of giving the curriculum writers a benefit of doubt there. Now, selection of an appropriate model. If it is a firm that is a stable growing firm, mature firm, slow constant growth firm, then it would make sense to use a single stage model. Those kind of stocks or those kind of firms, we label them as income stock, not growth stocks, right? So when also for international setting where you have volatile inflation, when inflation level is volatile, you don't want to use nominal cash flows. Why? Because your forecast error, your estimation error will be larger. You can't realistically be a good estimator of future inflation rates. Your estimation error will be large, right? So instead of that, use real rates, thereby removing that noise in your estimation, and then it will work better. So if you have a high growth firm right now, and in that case, it may be more appropriate not to force it into a single stage model, because then it will be giving you an extremely low value. Instead, it would make sense to use either a 2 or a 3 stage model, and you have to kind of come to some sort of a conclusion as to when the competitive advantage, the growth that the company is enjoying currently, when will that dissipate, when will it go away, and it will become a normal, stodgy, mature company. And again, that requires some level of subjective assessment. For us, that will be given to us directly, and so we are not going to subjectively determine that based on qualitative data. Now, you do an evaluation, and you get to, you plug in the details, you plug in the cash flows, and you calculate any value. But you recognize that the value you get is just a point estimate. That is just one estimate that you can derive. If those forecasts change, if those forecasted values, cash flows change, then obviously your valuation will change. So one way to determine how sensitive is your value and what are the key parameters, what are the key inputs it is sensitive to. So the risk factors, for example, beta, risk-free rate, and ERP. ERP is same as market risk premium if I was using CAPM. So if I was using CAPM to calculate my required rate of return, even if it is capital required return on equity or weighted average cost of capital, either way, I need to use cost of equity. Now, all of these parameters, all of these inputs can change. Why? Because we are again forecasting. We are not concerned about risk-free rate 10 years ago. We are concerned about risk-free rate going forward. So all of these input parameters can change. We want to figure out how sensitive is your value estimate based on these changes in input. We know that the growth rate and discount rate are very critical. Those are the parameters, those are the input values. Even if you change it a little bit, it will change the valuation significantly. The least sensitive components are free cash flow and risk-free rate. Well, risk-free rate obviously will change it, discount rate, but they are least sensitive on an empirical basis because indeed there is a lot more certainty of estimation of risk-free rate. The volatility of risk-free rate is generally, for most developed economies, pretty small. So your estimation error there is going to be very little. So your valuation estimate is fairly robust vis-a-vis those two input parameters, those two input values. Now, terminal value, again, if you're using 2 or 3 stage, multi-stage model, so you have individual discrete free cash flows that you're forecasted for the first n years, and then you're going to estimate a terminal value. That terminal value will be added to the last cash flows, plugged into your calculator, discounted at the appropriate rate to calculate value. If you're calculating firm value, the discount rate is WACC. If you're calculating equity value, the discount rate is required rate of return. The terminal value, as we said already, can be based on Gordon growth model, or if you're looking at FCFE based value, or if you're looking at valuation of equity only, then you can also use price multiple. Again, the assumption here is the price multiple is a control price based rather than market price based. So that is it for free cash flows, and this would be a great time to point out the value of doing practice question. Once again, don't just limit yourself to doing module concept checkers. Do a lot of practice questions from the QBank as well as end of chapter readings from the original CFA Institute curriculum books. That will be a good practice for you to solidify this material, solidify what you have already learned in free cash flows.